If you are sitting on cash because you think the AI trade is just a bubble of hype, you need to look at the port of Taipei this morning. The numbers released yesterday didn't just beat expectations. They shattered the ceiling of what we thought was physically possible for hardware demand in January. We are not talking about surveys or soft data anymore. We are talking about 69% growth in real, hard cash-changing hands for chips. Today I am going to map the line from that massive export number to Google's historic 100-year bond, and finally to the silent alliance between Hyundai and Waymo. By the end of this, you will see exactly how this macro liquidity is flowing directly into free cash flow for 2026. Let's map the line. Taiwan's exports were the top trigger, exploding nearly 70% and confirming the AI supercycle is accelerating. Then that demand signal flowed into capital markets, where Alphabet raised billions with a rare century bond to pay for the infrastructure to meet it. Finally, it spread to the industrial layer, where Hyundai and Waymo are turning autonomous driving into a foundry business. Stay with me, and I will translate these billions into the margins and earnings that matter for your portfolio. First, let's dive into the signal from Taiwan. The Ministry of Finance reported that January exports surged 69.9% year-on-year. The total value was $65.77 billion. A lot of people will dismiss this as a base effect because last year had the Lunar New Year holiday in January. That is a dangerous misconception. Even if you adjust for the holiday, this is the 27th straight month of expansion. Think of Taiwan as the toll booth for the global AI economy. Every time Microsoft, Meta, or Amazon wants to upgrade a data center, they have to pay the toll in Taipei first. When the toll revenue jumps 70%, it tells you traffic is jamming the highway. The breakdown tells the real story. Information and communication technology products surged 130%. This is the physical shipment of servers and switches. The earnings path here is simple. This export number is next quarter's revenue for NVIDIA and AMD. But more importantly, it confirms that the massive CapEx spending we saw in big tech earnings is actually being converted into physical assets. It is not just vaporware. For free cash flow, this means the semiconductor supply chain, especially TSMC and memory makers, will see their operating cash flow swell. This gives them the firepower to keep investing without tapping the debt markets too hard. The checkpoint here is clear. The hardware boom is not slowing down. It is broadening into a structural utility. Now, let's move to how this is being funded. This is where the story gets interesting. Alphabet just issued a bond that matures in 100 years. Most companies borrow for 5 or 10 years. Why 100? This is Alphabet telling the market that AI data centers are not disposable gadgets like an iPhone. They are permanent utilities, like the Hoover Dam or the national power grid. By locking in rates now, they are hedging against the inflation that comes with the energy transition. This flows directly into margins. If inflation spikes in 2030, Alphabet will still be paying 2026 interest rates on this debt. That protects their free cash flow margins for decades. It is a financial fortress that allows them to spend $185 billion this year without blinking. At the same time, we saw XAI raise $20 billion. Notice the pattern. The capital is moving from venture bets to sovereign-scale infrastructure. When companies raise this much cash, it eventually flows down to the energy providers and the chip makers. It is a circular economy of capital. XAI raises money, buys NVIDIA chips, and pays for electricity. If you own the utilities or the chip makers, this capital raise is your future dividend. While Google builds the digital brain, the physical body is being built in Georgia. Hyundai Motor has partnered with Waymo to become an autonomous vehicle foundry. I want you to focus on that word, foundry. Just like Apple designs the chip and TSMC builds it, Waymo designs the driver and Hyundai builds the car. This solves a huge problem for Alphabet. They do not have to build car factories, which burn cash and destroy return on invested capital. They just pay Hyundai a fee per vehicle. For Hyundai, this fills their new American factories with guaranteed orders. It is a margin expansion story for both sides. Waymo lowers its unit costs, and Hyundai lowers its fixed cost per unit by maximizing utilization. This is how AI moves from a chatbot to the physical world. It is not about a flashy new car launch. It is about the unit economics of a robo-taxi fleet becoming profitable. When you see foundry model in an industrial sector, it usually means margins are about to stabilize. Now, we have to look at the geopolitical floor. President Trump says his relationship with Xi Jinping is very good, and a visit is planned. Combined with the Kuala Lumpur agreement we saw recently, this puts a floor under the risk premium. Businesses now know the rules of engagement until November 2026. This reduces the cost of equity for every company with a supply chain that touches China. If you are analyzing Apple or Tesla, this is a massive relief for their valuation multiples. The market hates uncertainty more than it hates bad news. With the tariff timeline fixed for a year, the discount rate on these stocks can drift lower. Also, look at Japan. The LDP's landslide victory suggests the yen might stay stable. This keeps the liquidity spigot open for global tech. The yen carry trade fear is receding. Let's connect this to the UBS report on memory chips. They are forecasting that high-bandwidth memory prices will rise another 11% in 2026. Many analysts feared a glut. They thought memory would become a commodity again. UBS is saying no. HBM is not a commodity. It is a specialty component. Because it requires complex packaging, supply will stay tight. This means companies like SK Hynix and Micron are not just riding a cycle. They are entering a period of structural pricing power. When you have pricing power plus volume growth, your free cash flow margin expands faster than revenue. That is the sweet spot for an investor. So, what is the one thing you need to remember today? The demand for AI is physically verified by Taiwan. The funding is secured by century-long bonds, and the geopolitical risks are priced in for the next year. The capital cycle has moved from building models to pouring concrete and shipping silicon. Watch the spread between high-bandwidth memory prices and legacy chips. That is where the next margin breakout will be. I am Wilson. I track the flow of money so you do not have to guess. If this helped you see the board clearly, subscribe, and I will see you tomorrow.